future. We're talking real money.
Hello, everybody. Welcome to another exciting Talking Real Money. A Mother's Day weekend as we're doing this live. I'm Don McDonald, along with Tom Cock. Though, this time, instead of being... What? Yeah, you're there, right?
Yes, I am.
All right. A little bit of a delay. I'm getting there.
There is. You're going slow. You're slower than normal. You need to pick it up a bit.
Well, it's because I'm on the using the phone instead of my fancy tie-line device. So this was a test to see if it works as well. So far, probably not. I'm visiting my mother in North Carolina at her care home here. She's just turned 88. Just a little while ago. So she's sitting right here. She's my audience, along with the kibitzer, my wife, who's right next door. And Tom, make sure she knows to raise her hand.
If she doesn't put the hand up, she doesn't get on the air, just like everybody else, man.
If you don't put the hand up, you don't get recognized. There you go. Our phone number is 855-935-TALK, 855-935-8255. You can call us every Saturday, and we will spend some time talking about this really important stuff that you deal with all the time, which is money. And we talk a lot about investing, because despite the fact that investing is way too easy, way too simple, you make it incredibly complicated. You make it complicated. Wall Street makes it complicated. The professionals make it complicated because far too many people, and particularly professionals, believe there is a trick, that there are games and gimmicks and things you can do and strategies to make a lot more money than those plebes like the rest of us, Tom.
Yeah, and this is the thing that you struck it right on it. I mean, let's make this complicated. Let's make this unusual in a way. I mean, and things that you thought were dead, that were crushed, that were over from the, for example, 2008. I don't know what you want to call it, financial meltdown. They come back. Do you remember collateralized loan obligations? Yeah, this is coming back. I mean, pension funds, insurers have been piling into funds that invest in equity tranches of collateralized loan obligations in recent months. At least $3.5 billion in less than a year have gone into those investments in the last year. And people forget. Do you remember the term collateralized loan obligation, Don? Remember what that all meant?
I actually remember some things called collateralized debt obligations.
There you
collateralized mortgage obligations. There's a lot of these. And the thing about collateralized debt obligations and collateralized mortgage obligations was the fact that you could pick and choose the level of risk you wanted to take, the interest rate you wanted to get. So you could get really high rates, they said, with really low risk, with high degrees of safety. And what was great about these is how well they worked right up until they didn't.
Yeah, I mean, this is deeply subordinated debt. It's the last in line to get paid and the first in line to take any loss. When you think of it that way, the fact that you're, making a little more, right.
That's what the collateralized loan obligations are now, is that they're taking, at least collateralized mortgage obligations took high quality mortgages. They were backed by something. These CLOs aren't really backed by anything.
And yet here they are, because people are excited about the fact that they're going to make a little bit more. They're like 6%. And if you just go to standard issue intermediate term bond fund, it's paying somewhere between 4.5% and 5%. You can get money market interest at 5%. You can get high yield savings at 5%. But people are writing us, and apparently the smart money is going into this type of investment. I call it smart money with air quotes, because, again, they can see a little more interest, and they're not thinking about the other side of the equation here, that when things go south, and they will go south. I don't know when. I don't know what the cause of it will be, but this will be among the first things that takes a steep dive, correct?
And what is so problematic about this is the fact that this stuff is being sold. I've seen some of these ETFs that have these CLOs, and they're selling these things as AAA rated paper. That AAA rated paper is higher ratings than the U.S. government gets. Now, that is just horrific. In my opinion, that's just horribly misleading that you think, and that makes you think you can get something safer than a government bond paying.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
This Mother's Day weekend, because my mother's here, Debbie and I decided to drive up to Asheville, North Carolina, and visit her in her long-term care facility. But there's this show we still need to do, so I'm actually doing it from her room at the care facility in Asheville. So my mom is here watching. My wife is here watching. Tom is over there in Seattle watching. I don't know if he's happy about it, but he's over there.
I'm
and our
watching.
phone number is, and Debbie wanted me to, she raised her hand. She wanted me to know.
Oh, she did.
Wanted you to know the dogs are watching.
Oh, boy, you got just a huge captive audience there. So
I know, just massively popular. Oh, Debbie's got her hand up again. Oh, they're asleep. 855-935-TALK. That is our phone number, 855-935-8255. We would really appreciate it if you have a question about money that you give us a call and give us an opportunity to try to make these issues you deal with more understandable and point you in the right direction as opposed to so many of the wrong ones that you find yourself heading toward, like the tendency to want to move toward higher yielding debt or higher, particularly in a period of high interest rates, Tom. There's a lot, people are looking for that extra little bit of money, but they don't want to take any more risk.
yeah, and they forget that the two are tied. They need to be associated with each other because to make more, you got to put your neck out further. And the other part is what we've seen is, and we're seeing it again, is sort of this market timing move from one particular type of security, like stocks or bonds, into another, like cash. Now, we just talked a little bit about some of the risks that the experts are taking. And here's what some of the other experts are telling you. I like this comment, actually, from Jamie Batmer, who is the Chief Investment Officer at Creative Planning. I know the firm. And he says, for any client who has a longer time frame horizon, cash has underperformed equities 100% of the time over any trailing 20-year period. I think that's an important thing to know because people have this tendency to think, I'll move more to cash, like money markets, CDs, stuff like that, because it's paying 5%. You have reinvestment risk that you're not thinking of. You have the change in interest rates. It could come very quickly. Just had a discussion with this about somebody with someone recently and had to tell them, well, yeah, you're making 5 today, but it could be a whole lot less very quickly. And you don't want to be sort of moving around. So I like what Jamie said. I think that made sense. But when you get into some of these other folks that are telling you what to do, J.J. Feldman, co-head of wealth management at Helium Advisors, I guess their stock is really going up. He's telling you to get a little longer in your maturities, right? To put the risk, it doesn't mention risk, but just to hold longer maturities because you're going to get paid more, I guess, right?
Well, you're not going to get paid more. What you're doing is you're going to lock in a yield for a longer period of time. But what people forget in this advice is that long-term bonds, and that's what we're talking about. We're talking about long-term fixed income securities. Long-term bonds have at times, as a matter of fact, we just saw it in 2022, been as risky, almost as risky and volatile and scary and frightening and money losing as stocks without the upside of the big reward potential.
Yeah, and then there's Robert Conso, who is a financial advisor at the Wealth Alliance. I'm not familiar with the firm, who between mentioning going out longer in duration on fixed income, he also says, hey, how about some higher yielding securities like MLPs? Aren't those master limited partnerships, I think, or something? Or
master limited partnerships, those tend to be self-liquidating like oil and gas partnerships where you buy, or pipeline partnerships where you are getting some of your money back, and it appears that you're getting a very high yield, but in fact, slowly it's like an annuity. You're getting paid your principal back. And there were many of these back in the 80s.
80s, yeah.
These oil and gas partnerships that had these 12, 13, 15, 18% returns. T. Boone Pickens and Mesa Petroleum. These things had huge returns until they ran out of oil in those partnerships.
Yeah, the well ran dry. He also suggests private credit. Now, this is an area that people have gotten more and more into lately. They're more and more excited about it. There was just a piece in Bloomberg a couple of days ago talking about how advisors are getting people more into private credit because it pays more than public issued bonds. Well, guess why it pays more? I'm wondering, why would that be?
Well, and this is what happens when we have a decent, and for anybody who says this is a terrible economy, you guys are wrong. This has been a great economy, lots of jobs, payroll's been rising. Yes, prices have been rising too. That tends to be what happens in hotter economies. But the fact is that a recession, a real hard recession like we saw in 2008, is going to take these low-quality debt portfolios and destroy them because people are going to default left and right. You're seeing a bit of a preview of that potential, just that potential, not saying it's going to follow, in the commercial real estate market, where in so many markets, these high-yielding real estate partnerships were making a ton of money on all of these wonderful office spaces in these communities. They were filling, these office spaces were filling, rents were rising. We saw it ourselves when we were out renting offices. We go from one to another and the rents would just soar. But now, because, in large part because of COVID, the demand for office space has declined precipitously, and we really haven't even seen the great unraveling yet.
Yeah, we're still waiting to see people that won't be able to pay the bill, people that will default on loans, what this will all mean in the longer haul. You've seen REITs, real estate investment trusts, are still underwater this year. Have had a tough couple of years because people are saying this is coming. We don't know when. We don't know totally what it's going to look like, but the trend is not your friend. When even here in a pretty healthy economy in Bellevue, Washington, a third of the office space is not rented right now. A third. So, and this is a pretty booming type of place. You got a lot of technology players around, but and Seattle's worse. So yes, this is a troubled part of the economy. But again, I just want to make sure we close out on this, and then we can talk a little bit about what we've seen individuals doing lately. And because there is no wealth without risk, there is no easy way to make an additional 1%. And if the safe part of your portfolio is fixed income, which we'll talk about in just a moment, reaching for yield to make more on that has proven historically to be a terrible decision, either by going longer on duration, lowering your quality, or any of those sort of things. People have learned very painful lessons that the risk they take was in no way worth it because the price they paid in terms of reduction of the value of that investment.
We have seen so many cases where Wall Street has created these investment devices. We saw it with as we mentioned, the collateralized debt and mortgage obligations. I mean, think about it for a minute. CDOs and CMOs nearly took down the biggest insurance company in the world and took down several of the largest investment banks. And it was because they were investing in things that even they, as experts, didn't fully understand. And you don't stand a chance. If they can get beaten up on these things, thinking they're getting something that they really didn't get, then what chance do you stand competing against them? I think it's none. 855-935-TALK is our phone number.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Because it's really, really important. And we really invite you to call us and talk about some of the things that you're dealing with, whether it's investments or trying to save for some sort of a project or earn a little bit more money or protect your future or do a college plan for a kid, whatever it is, we'll help you figure it out, and we'll do it without all the garbage and the jargon and, frankly, the lies that you get all over the place. 855-935-TALK, 855-935-8255. And we also get your questions from TalkingRealMoney.com. They get both spoken and typed in. And Tom has a pile of typed questions.
Yeah, I've been getting a lot of these. Jim writes us from Graham, Washington. Okay, gentlemen, less than 2 years ago, I called and discussed my portfolio with you on the air, and Don mentioned I had no bonds. I said, I didn't like bonds. Don suggested I have 25% of my portfolio in at least two different types of bonds, a total return market bond and a U.S. index bond. I took a suggestion. Within a year, I'd lost up to 25% in value overall in those bonds. Needless to say, I was not happy and should have stuck to my beliefs. Since then, you have not once mentioned that I know of what investors should do with their underperforming bonds. Stay in them? No bonds I know of ever covered. Or what we do to help recover from the losses in value. T. Rowe Price, Vanguard, Fidelity all have similar values. Tell us what to do, please. I do not need income from the bonds.
That's exactly what we've been saying, too. You need income from the bonds. What you need is the relative stability of bonds. And by the way, I have never in my entire career suggested a total return bond fund in, like PIMCO's total return.
For just the reason you just mentioned. Because it's not about that. It's really is about stability,
not about the income.
Exactly.
But the reality is, the only funds that we've suggested regularly on this show, well, the main one is the Vanguard Total Bond Index, not total return, but total bond index, which has not performed well in the past couple of years. But that's not the point. But it never lost 25%. Not once.
No, it didn't lose. In 2021, it was down 1.8%. In 2022, the horrendous year, is down 13.1. But then last year, up 5.6. And this year, down 1.8. So, again, we see nowhere near the 25. But back to your question, Jim, because this is not unusual in investing experience. Somebody tells you to do something, you go do it, and it appears to be a disaster. Well, in this case, I don't think it is, because let's give a comparison, just for sake of argument. Let's assume you stay 100% in stocks, right? And the stock market has a bear market. And when that happens, what happens? Well, stocks can go down 50%. So there's no really comparison between the reduction.
They can go down more, but historically they've gone down up to about 50% in a year.
Yeah. So you could really have a bad day, a bad year there. Number two, do I think you should sell them? No, because again, bonds are there. Well, any investment, anything you do with less than 5 years, that's not investing, that's speculating. You're not investing because things take time, and that's the same true of bonds, stocks, those sort of instruments. You need to be properly invested. Number three, this is the part that I feel bad, Jim, that we maybe didn't explain this well at the time. Don't know, but we didn't. Your portfolio should be designed on what your need for return is and your willingness to take risk is. If you told us, look, I don't care if I go down by 50%, I doubt we would have told you go buy bonds. If you told us, I'm retired as you are, and I really don't want to lose a lot of money, we would have told you to buy bonds. And we would tell you the same thing today if you called.
Yep, exactly the same thing.
It hasn't changed. Yeah. So,
and it's funny, the only bond area, and we talked about this earlier, stretching for yield, going out for those longer yields, longer maturities to lock in a yield longer. That's where people lost 25%. If you had purchased the Vanguard long-term investment grade bond fund in 2021, you would have lost 25% in 2022. But we have, and we go back to the tape, we have never, ever on this program or any other suggested long-term bonds to anybody because they are highly volatile, just like we saw in 2022. Yeah, you might lock in a yield for a longer period of time, but you're going to suffer through greater fluctuations as interest rates change because of that lock-in, because of those longer bonds. 855-935-TALK. Give us a call or go to TalkingRealMoney.com.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Now, this program becomes a podcast next week. All of our Saturday shows become a podcast. So we air on Saturdays in the Seattle area on Northwest News Radio. And did I just hear the weather report properly? Did
yeah,
the
weather's
80s?
Outrageously great. Yeah. Indeed.
80s?
80s,
Seattle?
dude. This is like get on my deck, get a cigar, and start reading or something. I'm telling you what. It's good.
So between the nice weather and everybody flocking to Medina to give Biden money.
Yeah, pretty much. They can call from their cars. They got cell phone towers in Medina. They work, sure. Yeah.
Okay, well, maybe that's where Benton is. Hey, Benton, welcome to Talking Real Money.
I'm trying to check my...
Benton, you there?
Benton, you need to turn off your radio.
Hello.
Hey, you got to shut down that radio.
Hey, Benton. Okay, what's up?
Hey, my wife and I are in our mid to upper 70s and in reasonable health. We have about $240,000 that we just recently placed with Fidelity to set up some investments and to build that hopefully 240 plus on up to where we think we could probably live comfortably. And we aren't quite there, figuring the way things work. We do have, we own two
where do
homes.
you think you need to be?
Well, I'm hearing or reading that, for a couple to continue to live in the great Northwest, which is fairly expensive, we may need another $100,000.
Yeah, I mean, so that okay. So you're saying you need growth of about a third on top of the money that you have saved, right? I mean, which frankly would be a lot. I don't know. Have you done any? And I thought you started to mention that you have a couple of homes, 2 homes. Is that what I heard?
Correct.
Okay, so, but here's the way I would work it rather than that. I would sit down and say, okay, here's how much we need on a monthly basis, and here's what we want to do in our 70s. That's a number, right? It's a number for me, it's a number for Don, et cetera. That's the cost of living, if you will, everything thrown in. That's a number. Then you start subtracting out the stuff, Benton, that you get on a regular basis, like Social Security, pensions, whatever. Then you're left with the other, the number that's left. I would then look at the
extra,
the 240,000 and say, out of that 240, I need to draw X to make sure that I can meet my needs for whatever period of time. That's how I would do it, rather than saying, wow, it's expensive to live in the Northwest, and you're right, it is, and I need to make so much on my money to grow it by a third, because that seems a difficult proposition to me.
That's the big one. Yeah. It's a little, I think.
And the problem, Benton,
really
is that we often, as investors, we get it backward. We start from the back end. We say, well, I've got money. How do I invest it? But we don't know what we want that to do yet. You need to be very precise about your budget. Yeah. And that's important.
Okay.
And just out of curiosity, you've got it at Fidelity now. Where do they have it invested yet? And if so, in what?
Well, we just did it within the last couple of weeks. And the money has shifted over from another, management company that we were not too pleased with as far as customer service.
Conservative to moderate.
Yeah. My wife's here.
Well,
too.
do us a favor.
You want to?
Yeah, both of you do us a favor. When the person at Fidelity calls you and says, we want to do X and Y and Z with it, call us before you do it. It's always better to get
There you
another
go.
opinion before you do something than after the fact. So do that. But
Right,
also,
to
as
pull it
Tom
out,
said,
yeah.
sit down and start that plan. You need to know, it's so simple. You just put your spending down on a piece of paper and then subtract out your income sources that you depend on, like Social Security. And then we can come up with a number that the 240 or whatever it grows to needs to generate.
Okay. Well, very good. That's good advice. We will follow that and get back to you. I think probably within the next couple of weeks.
Perfect. Please do. 855-935-TALK is that phone number. 855-935-8255. Call us before you do stuff, because we can help you before it's harder.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
There really isn't a whole lot that you deal with day in and day out like you do money. Money's an important part of life, and it deserves some more conversation, honest conversation. Give us a call. We'll do that with you at 855-935-TALK, 855-935-8255. And James, you're up next. Welcome to Talking Real Money.
Oh, hi. So my question is, my wife and I are in a little bit of a conundrum at the moment. We do have a pretty healthy retirement portfolio, but she wants to purchase a second beachfront home somewhere in Washington State. I'm here in Washington State. And my concern with that is I'm 60, she's a little bit younger, but is that the best advice to do with purchasing a home, beachfront home, as a second property in Washington State, looking at the next few years and then trying to resell it? Like I said, I'm on the fence with doing this. She's kind of adamant, but I seek some advice.
Well, how important is your marriage? I mean, if she's adamant, I think I'd have to go along with that. I don't think there's a whole lot of argument here, James. Just sign the check. I mean, because you said a couple of things, a little bit of mixed message. So if my wife came to me and said, we got to really go buy a home on Lake Chelan because we go there every summer, it's going to make sense. We got the kids and grandkids, whatever. It would not be for profit, though. It would be for purpose, because you kind of mixed your metaphors there a little bit, because at one point you said it's important to her, and then at the other you said, well, we might only keep it for a couple of years and need to sell it. I would never buy real estate that I wasn't going to hold for at least 5 years, because, gosh, we just don't know the ups and downs of the market, maybe even longer than that. I see Don saying, I wouldn't hold it less than that.
I wouldn't buy real estate unless you plan to keep it. Real estate's a terrible investment. Yeah, I mean, if you're buying it for a lifestyle reason, yeah, go get it. If it's, well, we're going to buy it because we think beachfront property is going to go up, ooh, don't do that.
And I would say that was not actually my intent. If that came across that way, that was not the intent. The intent was definitely she just wanted to have a second home, beachfront property somewhere, under. And here's the kicker: under $400,000, so we could just pay cash for it. But again, I was looking at the bigger picture down the road. good investment or
There's
not.
a place in the United
States
States of America where you can get beachfront property for less than $400,000.
I'll come in for half of that. No
Really?
question. Ring me up on Monday. Yeah, I mean, so, but then again, that you mentioned something right at the end that is important. Number one, you said you have the cash to buy this. Number two, does it impact your retirement plan? Because if you're 60, you're in the red zone here. You got to make sure you're going to have the assets you need to pay the bills when you stop working. And then I think Don's absolutely right. Make sure this is a long-term commitment.
Lifestyle thing.
Right. And no, I do have it. It would not impact my retirement, so it wouldn't be an impact at all.
I live in Florida, and I can guarantee you there are a lot of people in Florida who bought beachfront property in the past couple of years who are regretting that purchase.
Oh, boy. Yeah, ever. And just having homeowners insurance on it now is so ridiculous, too. There's other factors. But again, if you're calling us and asking us if it makes sense financially, we don't really know. But if you say you have the money and it's not going to impact your retirement and it's something you want to do, I'm going to say check the box and get to it. Don's right. $400,000 for anything along any coastline, basically on the West Coast today, is pretty doggone good deal.
Any coast, the Mexican coast, the Central American coast.
In my initial search is $400,000 get you a 1-bedroom in the woods somewhere, but the ocean's close by.
That's not beachfront.
That doesn't sound exactly the same, James.
That's like
yeah, okay. Yeah,
Beach Drive. Anyway, thanks for the call, James. We appreciate it so much. Thank you, sir. 855-935-TALK is our phone number, 855-935-8255. Joyce, you're up next. Welcome to Talking Real Money. Hi, Joyce.
Hi, thank you so much. Hi. I'll make this as simple as I can to make it easy for you. I'm 70 years old, retired for the last 14 years, and I was just recently widowed. And I have a 401k plan in a large company that I retired from. And since that time that I retired, the last 14 years, I've had it in the stable value fund, which has grown steadily but very slowly, as you can imagine. And so, I'm 70 now, so by the time I'm 73 or 75, I'm not quite sure which it's going to be. I have to start taking out the RMDs, I think they call them.
Yeah, that's right. You'll have to do that at 73. Minimum. You'll have to start taking the money out of that account and paying tax on it. Correct. Yeah.
And right now, I have a decent income with my Social Security and my pension and my husband's state pension. I have about $5,500 a month coming in after tax, excuse me. So I'm doing okay. It's not like I'm needing this money in my 401k, but I want to make it last as long as possible. And I have about $350,000 in there right now. And I just need to know, what should I do? Start taking it out and investing it in something very safe, or I have a low tolerance for risk.
Yeah, it sounds like it. I mean, the stable value fund is exactly that. It kind of holds its value. It might be close to inflation, not anything much above it. Yeah, the question to you is, that last part you mentioned, so important to know yourself about volatility. How much down can you take? Because we don't know when the down is coming, right?
Right. And the other thing that we talked about with a previous caller is the importance of knowing what it is you need from the money, because you're going to take it out in our RMDs. You're going to pay the taxes on it, and then you're going to have money left that you're not spending. What do you want that money to do for you in the future? Is it just money that's going to go away for a rainy day? Or is it money from which you might need a greater income in the future? Those are just some of the little things, big things you have to figure out.
Right. I don't have children, and so it'll just be for me, but of course, I need it for old age and taking care of myself and that kind of thing. So that's my main goal, is certainly to have a little fun, to maybe travel a little bit, but that's not crucial. Mainly, I need it to take care of myself in my old age.
Yeah, I mean, so then maybe you put your toe into stock a little bit, just 10 or 20% of it. Don's going to get all worked up here because
I actually do think you should put 10 or 20% in stocks.
Okay.
But I think it's going to be painful, possibly.
Yeah. I mean, we just don't know when the next bad thing could happen that drives those prices down. Go ahead.
Do you think, I was thinking of maybe like some kind of balanced index fund.
Well, that's going to be a balanced index fund is going to be way more aggressive than what we were just talking about. That's going to be 60% of your money in stocks, 40% in bonds, or close to it.
How about something like a 2020 target date fund?
Yeah, 2020 target date fund. You're probably 40% in stocks, 60. So, Don, a 2020 is a good one.
I think it's 37. I think it's about 30/70.
Yeah, so at least you have a little stock exposure that can keep you ahead of inflation. And if you draw, for sake of argument, 4% a year from that it should survive for a fairly long period of time with, yes, some volatility, but not a lot. So that would allow you to take, $12,000 to $15,000 a year off the portfolio, get enough growth to keep it from declining much in overall value if the past, is prologue, right? If the future looks like the past.
Yeah, the trick is for the past.
I forget to mention.
I'll tell you what, hang on for just a minute, and I'll get to what you didn't mention yet right after we take a quick break. 855-935-TALK. Remember that number every Saturday, noon to 2 Pacific, 3 to 5 Eastern.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I looked it up. Target 2020 is about 65-35, so target 15 is probably closer.
I think we think too aggressive for you, Joyce, but what were you going to add one piece of critical information? What is that?
Well, I think it might be important. I forgot to mention we also do have some money in stocks, about $60,000 in stocks. So we had been just letting that grow. So I do have some exposure to that.
I like Don's idea. I would go with it.
In what form, too, though?
Like those
is
are
it
individual equities.
Stocks?
I'm betting.
Yeah, 2 individual stocks.
We figured as much.
Berkshire Hathaway B.
Good company. Been done pretty well for a long time. I like Don's idea. Let's scale back the risk just a little bit. Go with the 2015 target date fund. With that,
thank you. Okay.
With that 401k amount, that is going to give you somewhere around 40 to 50% exposure of your money to a pretty diversified stock portfolio. The rest is going to be in stable, like bond, not stable value, because that's actually an insurance product. That is, anyway, these are going to be primarily government debt.
High quality bonds.
Yeah, high quality bonds. And the idea here will be to make 4, maybe 5% a year. Hopefully inflation starts to run at that rate over the long haul. So you stay a little bit ahead of inflation. You draw out that 4 to 5% a year and do those other things, which I think you should absolutely 100% do. I'm sorry for your recent loss. Get out and enjoy those things because we run into people all the time who say, I'm going to wait till I'm 80. Well, I didn't really want to go anywhere at 80. So get out and have some fun now.
Thank you so much.
Absolutely.
I appreciate your help very much.
Thank you, Joyce. You take care and call anytime. 855-935-TALK, 855-935-8255. And it's just free and easy. And we're here every Saturday from noon to 2 Pacific time on Northwest News Radio. And no matter where you are in the world, you can call us. I think, I don't know if the 855 works in the U.S.
We should try. I'll try that when I'm in Africa. I'll try dialing it from there, see what happens.
Yeah.
We'll find out.
All right, we'll find out. Well, Tom's
in
Africa.
On safari.
Tom's going to be out on safari this summer. Then later in the summer, I'm going to be just driving a trailer across the country, which, by the way, we took it out for its first road trip yesterday.
Yeah, how's that all going?
And it's great. Some guy walked by up at the campground and went, oh, that's nice. What year's that? I said, 89. He goes, wow, that's in good shape. I said,
that's a classic year for the...
That's a classic year, exactly. So we're camping out.
Still with wheels.
We're also doing Mother's Day with my mom right now, literally right now. We're in her room.
She's there.
At the long-term care facility. Debbie and I and the dogs, and of course, we'll be here again tomorrow, but we won't be doing a show for you then. And if, by the way, you would like to meet with a real live human advisor person who will help you start at the beginning and not at the end.
Yeah, thank you for that.
Yeah, because it's like, well, I've got money. How should I invest it? Well, we don't know. What do you want it to do? You got to know that. And to sit down with somebody and get that one-on-one and not get a charge for it and not feel like you're obligated to somehow become a client, not even get a high-pressure sales pitch. You're not getting pressure to do anything. All you need to do is go to talkingrealmoney.com and click on that button there that says Meet an Advisor. It's right there. And if you want to follow along with the road trip or see some of us along the way, Tom's going to be in Madison meeting with people who having those exact meetings. So go to Talking Real Money. Just click on buttons. If you click on a button, something somewhere is going to happen. Somebody said they couldn't find the podcast. Yeah, it's right there. Just scroll down the page.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.